The Disciplined Prophet, the life, philosophy, and timeless lessons of Paul Tudor Jones II. Good morning. It is a privilege to be with you all once again as we continue our exploration of the most formidable minds in finance. We have studied the architects of long-term portfolios and the masters of global value. Today, we shift our focus to a different dimension of the market, the arena of pure price action, of macroeconomic tides, and of disciplined tactical speculation. We are entering the world of the macro trader, where time horizons can be months, weeks, or even days, and where the primary goal is not just to grow capital, but to preserve it at all costs through every conceivable market condition. This is the realm where conviction meets contingency, where a thesis is nothing without an escape plan. Our subject is Paul Tudor Jones II. He is a legendary figure, a man who combines the tape-reading instincts of a Jesse Livermore with the macroeconomic vision of a George Soros, all governed by a risk management discipline so rigorous and unemotional it has become the gold standard on Wall Street. He is perhaps most famous for his prescient and exquisitely executed prediction of the 1987 stock market crash, a call that cemented his reputation and demonstrated the awesome power of his unique, multifaceted methodology. But to define him solely by that one trade is to miss the essence of his genius. His story is a gripping narrative of pattern recognition across centuries, psychological fortitude under immense pressure, and an almost religious devotion to the principle that the first rule of making money is not to lose it, and the second rule is never to forget the first. Act 1. The Apprentice. From the cotton pits to a global macro vision, Paul Tudor Jones II did not follow a conventional groomed path to Wall Street. He grew up in Memphis, Tennessee, and attended the University of Virginia as an undergraduate before earning his MBA at UVA's Darden School of Business. His first formative immersion into the markets was not in the staid world of blue-chip stocks, but in the chaotic, visceral, and pitiless world of commodity futures. He started in 1976 as a clerk on the floor of the New York Cotton Exchange, learning the business from the absolute bottom up. This physical apprenticeship was critical. On the frenetic trading floor, he was immersed in the raw, unfiltered dynamics of supply and demand. He learned to read the tape, to sense the market's immediate rhythm, sentiment, and directional pressure from the furious flow of orders, the shouted bids and offers, and the changing prices on the chalkboard. It was a training in market microstructure and human emotion played out in real time. It was here that he met the renowned and disciplined cotton trader Eli Tullis, who became his crucial mentor. Tullis taught him the intricate fundamentals of the cotton market, weather patterns, crop reports, global demand. But more importantly, he instilled in the young Jones a deep, non-negotiable respect for risk management and the perils of over-leverage. Yet Jones's intellectual curiosity could not be contained by the cotton pits. He was, and remains, a voracious reader of economic history and a dedicated student of macroeconomic theory. He began to see connections between seemingly disparate markets, how movements in currencies, government bonds, and commodities like oil and gold could all be driven by the same underlying macroeconomic forces, central bank policy, inflation expectations, and geopolitical shifts. In 1980, sensing the opportunity in this interconnected view, the 25-year-old Jones founded Tudor Investment Corporation with a small amount of seed capital from family and friends. His early focus was naturally on commodities, but his vision was rapidly expanding into what would become known as global macro trading. This approach suited his talents and temperament perfectly. It required a top-down synthesizing view of the world, an ability to understand how interest rates, fiscal policies, and trade flows would create powerful, durable trends across entire asset classes and national borders. He was not a stock picker, analyzing balance sheets. He was a trend follower and a dislocation spotter. His goal was to identify these large-scale macroeconomic misalignments and tidal shifts early, and then use the leveraged tools of futures, options, and currencies to make precision bets on their continuation. The mid-1980s provided the perfect volatile backdrop for this burgeoning approach. The world was in a period of massive financial transformation. The Plaza Accord of 1985 An agreement among major nations to devalue the US dollar had set the stage for a dramatic currency realignment. Jones, understanding the implications of coordinated central bank intervention, made a fortune by betting against the dollar. But his true masterpiece, the trade that would define his career and elevate him from mere success to legendary status, was still to come. It would require him to combine every lesson he had learned, from reading the tape to understanding macro flows to employing ruthless risk management. Act 2, The Prophet of 1987, a masterclass in pattern recognition and asymmetric betting. The year 1987 began with a powerful, seemingly unstoppable bull market in U.S. equities. The Dow Jones Industrial Average had been rallying for 5 years, and by the late summer, it was up over 40% for the year alone. The mood was one of euphoric, can't-lose optimism. The phrase portfolio insurance gave institutional investors a false sense of security. But Paul Tudor Jones was growing increasingly, profoundly uneasy. His concern was not a gut feeling, but a conclusion rooted in a powerful synthesis of technical analysis, macroeconomic analysis, and a profound, almost scholarly study of financial history. He was a dedicated student of market cycles, and he saw disturbing, uncanny parallels between the market structure and sentiment of 1987 and that of 1929, just before the Great Crash. He immersed himself in charts and data from that period. Technically, he noticed a critical bearish divergence. While the major indices like the Dow were being pushed to new highs by a handful of large stocks, many broader market indicators like advanced decline lines and the number of stocks making new highs were weakening and not confirming the strength. The market's foundation was narrowing, a classic sign of a top. He was also deeply influenced by the work of technical analyst Robert Prechter, who was forecasting a massive market top based on Elliott wave theory. But Jones, true to form, was not a blind follower. He used Prechter's work as a hypothesis, not a command. He did his own independent work. He developed a powerful thesis that the global macroeconomic environment was becoming dangerously unstable. Interest rates were rising globally as central banks fought inflation, and the dollar was weakening again after the Louvre Accord attempted to stabilize it. Most crucially, he identified the then novel and widely adopted phenomenon of portfolio insurance. This strategy, used by large pension and mutual funds, involved systematically selling stock index futures in a declining market to hedge their equity portfolios. Jones, with a trader's intuition for system dynamics, understood that this was not a stabilizer, but a potential accelerator for a crash. In a downturn, these automated mechanistic sell programs would trigger a vicious, self-reinforcing feedback loop. Falling prices would force more futures selling, which would drive cash market prices down further, triggering even more program selling. It was a financial doomsday machine. In the months leading up to October, he began to carefully, deliberately build a significant short position in the stock market, primarily using S&P 500 futures and put options. He was betting on a collapse. But what is most instructive and illuminating about Jones's approach was not the prediction itself. Others, like Prechter, saw the risks too, but his meticulous risk management and asymmetric trade structuring. He understood that being intellectually right and being financially right are separated by the treacherous gap of timing. The market could become even more irrationally exuberant, squeezing shorts relentlessly before it finally cracked. Therefore, he hedged his hedge. He used a small portion of his capital to buy out-of-the-money call options. This was a brilliant, counterintuitive tactical move. If he was wrong, and the market continued its manic rally, his losses on the short futures would be partially, and potentially significantly, offset by the explosive gains on the long calls. The premium paid for these options was his insurance policy. It allowed him to maintain his core, high-conviction short position with a level of psychological equanimity and financial safety without facing catastrophic ruin if his timing was early by weeks or months. He had engineered an asymmetric payoff, limited, defined downside if he was wrong, and enormous exponential upside if he was right. When Black Monday struck on October 19, 1987, The Dow Jones Industrial Average plummeted an astonishing 22.6% in a single day, the largest one-day percentage decline in history. The portfolio insurance feedback loop played out exactly as Jones had foreseen, creating a waterfall of selling with no natural buyers. While panic, disbelief, and paralysis gripped the financial world, Tudor Investment Corporation was calmly, systematically profiting. Jones's flagship fund, the Tudor BBI Fund, reportedly gained over 200% in 1987, a staggering result achieved because of the historic market collapse. It was one of the most spectacularly correct, well-structured, and courageously executed trades in financial history, a perfect fusion of macro insight, historical pattern recognition, technical analysis, and, above all, defensive genius. Act 3, the discipline system, the bedrock principles of a trading legend. The 1987 trade made Paul Tudor Jones an international legend, but it was his systematic, process-driven approach to all trading that made him sustainably, consistently wealthy over decades. He did not rely on a series of brilliant one-off calls. He built a durable business around a repeatable, teachable process grounded in a few core, non-negotiable principles. These principles form the constitution of his trading philosophy. First, the religion of capital preservation, the paramount rule. Jones has famously and repeatedly said, "I'm always thinking about losing money as opposed to making money." This is not just a catchy aphorism, it is the foundational pillar, the sacred text of his entire philosophy. He inverts the natural impulse. He focuses on the downside first. Before he enters any trade, his primary concern is not the potential upside, but the potential loss. He determines his maximum acceptable loss for a trade, his pain threshold, and then sizes his position so that a worst-case scenario move would only inflict that predetermined, tolerable wound on his portfolio. This obsessive, preemptive focus on not losing allows him to survive the inevitable periods of being wrong, to withstand drawdowns, so that he remains solvent and psychologically intact to capitalize when his high-conviction trades finally pay off. In his world, survival is success. Second, the imperative of a market narrative, the three-legged stool. Jones does not trade based on hunches, tips, or isolated indicators. Every position must be supported by a compelling, logical story, a coherent narrative that explains why an asset should move in a certain direction. This narrative is built on what he calls the three legs of the stool: macroeconomic analysis, the big picture backdrop of interest rates, economic growth, and policy; fundamental analysis, the specific supply-demand dynamics of the asset, e.g. crop reports for wheat, earnings trends for a stock index; technical analysis, the message of the price chart, which reflects the collective psychology and positioning of all market participants. If a trade idea doesn't have a strong story supported by all three legs, the stool collapses, and he won't take the trade. This framework forces rigorous, multi-dimensional thinking. Third, the primacy of technical analysis and trend following. The trend is your friend. Jones is a master chart reader. He believes that price charts are a graphic representation of the collective knowledge, fear, and greed of all market participants. They are a voting machine in real time. Charts reveal trends, and his core strategy is to follow the line of least resistance, to trade in the direction of the established trend. He uses moving averages to define the trend, momentum oscillators to gauge its strength, and classical pattern recognition, head and shoulders, flags, etc., to identify potential inflection points. He has little patience for catching a falling knife or trying to heroically pick a top or bottom. He waits for the market to show his hand through a clear price breakout or breakdown, and then he joins the move, aiming to capture the meat of the trend. Fourth, the relentless calculus of position sizing and risk, reward, the P&L dance. This is where his discipline transforms from theory into profitable practice. Jones is a master of what he calls the P&L dance, the dynamic management of a position after entry. His rules are ironclad scale-in. He might start with a small starter position, e.g. 20% of his intended size, to test his hypothesis without much risk. Cut losers immediately. If the trade moves against him by a predetermined amount, he exits. Full stop. No hope, no prayers, no averaging down. A small loss is a cost of doing business. A large loss is a failure of discipline. Pyramid winners. If the trade moves in his favor, proving his thesis correct, he adds to the position, pyramiding his way in. He only adds to winners, and he never ever adds to a loser. Demand favorable asymmetry. He insists on a minimum risk-reward ratio for every trade, typically aiming for 5-to-1 or better. He is willing to be wrong multiple times on small 1-unit loss trades to catch one large 5-unit or more winning trend. Fifth, psychological self-awareness and the sanctuary of a system. Jones is intensely, famously focused on the psychology of trading. He understands that fear and greed are the trader's eternal, internal enemies. He has spoken extensively about the emotional cycle of a trade, the anxiety and doubt at inception, the euphoria and overconfidence when it's working, and the despair, denial, or panic when it turns against you. To combat this, he relies utterly on his system. His predefined rules are his anchor in the storm of emotion. When asked what he learned from the 1987 crash, he didn't dwell on the brilliance of his call. He reflected on the immense emotional toll and the absolute necessity of having a mechanical process to manage the psychological pressure. The system is the thing that allows the human to function. The timeless lessons for the modern investor. While most of us are not global macro traders levered up in futures, the core principles of Paul Tudor Jones are universally applicable to any form of investing, capital allocation, or even entrepreneurial risk-taking. 1. Don't be a hero. Focus on the downside first and always. The single most important takeaway from Jones's career is his obsession with not losing. Before you make any investment, your first and most urgent question must be, what is my exit strategy if I am wrong? Where is my stop? Define your risk up front in cold, hard numbers. Set a mental or actual stop loss. Protecting your capital is not a secondary concern. It is the primary mission. A preserved capital base can always find another opportunity. A decimated one cannot. 2. Have a thesis, not a tip. Build your three-legged stool. Every investment you make should be based on a coherent, logical narrative you can articulate clearly. Why should this go up? What are the fundamental macroeconomic and technical reasons supporting your view? If you cannot clearly explain this to yourself, if your thesis relies on someone smart said so, or it's been going up, you are not investing. You are gambling on noise. Build your own stool. If one leg is missing, don't sit down. 3. Price is the ultimate reality. Respect the tape. No matter how compelling your fundamental story, you must respect the message of the price action. The market is a discounting mechanism that knows more than you do. If the price is moving decisively and persistently against your position, it is telling you that your narrative may be flawed, incomplete, or at least premature. Do not argue with the tape. Do not hope it will come back. Have the humility to admit that the market is informing you that you are wrong and exit the position. Be right or be out. 4. Let winners run and cut losers short. Invert your natural instincts. This is the oldest adage in trading, and Jones is its most successful modern embodiment. The natural human tendency is to take small profits quickly, to feel success, and to hold on to losers, to avoid feeling the pain of being wrong. This is the most common, systematic destroyer of investment capital. You must practice with discipline the exact opposite. Be quick to admit small mistakes, and have the courage and patience to let your profitable ideas develop into major winners. Your portfolio should be a graveyard of small, clean losses and a gallery of a few large, framed victories. 5. Your system is your salvation. Emotion is your enemy. In the heat of the moment, during a market panic or a roaring bubble, your emotions, fear, greed, hubris will betray you. The only defense is a predefined, written set of rules created in a state of calm objectivity. Your rules for entry, exit, position sizing, and risk reward must be decided before you are in the trade. When chaos reigns, your job is not to think, but to execute your system without hesitation or deviation. The system is the brain. You are merely the hands. Paul Tudor Jones II remains one of the most respected and enduringly successful traders of all time because he mastered the internal game before he mastered the markets. He understood that while forecasting is an imperfect art, risk management is a perfectible science, and unbreakable discipline is the bridge between them. His career is a powerful testament to the paradoxical idea that in the markets, the boldest moves are often not the biggest, most aggressive bets, but the most disciplined, pre-planned exits. He showed us, with stunning clarity, that the true secret to longevity and monumental success is not merely in predicting the storm, but in constructing an unsinkable, self-righting ship long before the first cloud appears on the horizon. Thank you.